Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Hey everyone, it's another Market Radar podcast. Today is June 30th, Thursday. Today's a Thursday. We're recording on a Thursday. Got a busy weekend ahead of me. So midweek year-to-date performances. S&P is down 19.92%. NASDAQ down 28.67%. Russell down 23.27%. Dow Jones down 14.66%. All of these indexes are still bearish trend. Nothing has changed. Our system slightly updated for midweek since last weekend. So we have a slight downtick in deflationary odds, slight downtick in inflationary odds. Stagflation remained the same. Expansion, slight uptick. These are very negligible. Nothing has really changed since our last podcast. So the economic calendar. Monday is a holiday. Don't forget that. Tuesday, we've got motor vehicle sales, factory orders. Wednesday, we've got ISM Services Index, JOLTS, FOMC minutes. Thursday, we've got ADP Employment Report, International Trade in Goods and Services, Jobless Claims, EIA Natural Gas Report, EIA Petroleum Status Report, and the Fed Balance Sheet. Friday, we've got employment situation. So, let's look at how ES is doing for the week. Pretty rough week. It has come down quite a bit.
Yeah, we're actually just slightly under mid vamp. We started the week out just above mid vamp, went right through mid vamp, and now we're just under mid vamp.
Yeah. So this is a short-lived bear rally.
Yeah, and for the bear rally, it almost looks like a little bump in the road, right?
Yeah.
Compared to what we saw in like March, where we all got all the way up to Momo. If we went to Momo from here, you're talking you want to talk about people getting FOMO?
That would be
From
maximum
here,
FOMO.
yeah, it would. It's a 15% move higher from here. You want to talk about FOMO? I want to talk about a short squeeze from here to Momo. Could still very well stay risk off. Remember, that doesn't really change much. It's just a counter trend move at that point, but devastating to those that invest with emotion. But for those that don't know what mid vamp is, it's pretty simple. It's the middle of the upper and lower vamp, and that's where there is almost an even or there is an even percentage of upside and downside at the current price. So the odds of up and down are almost balanced. The further you go towards lower vamp, the higher the odds are that you reverse towards upper vamp and vice versa. So when we say mid vamp, it's almost like the little syringe balancing on Thanos' finger. You know?
Anything can happen pretty much.
Anything can happen. Yeah, exactly. So you want to take us into ZN?
Yeah, let's look at ZN. So it's up. It's up quite a bit. How much is it up from the lows? You want to measure that?
Let me measure that real quick. About 3.5% off the lows.
3.5%. So pretty big move off the lows. People are calling deflation. That seems to be the topic nowadays. But we're going to talk about that today.
Yeah.
After we go through the Fed minutes and stuff. Not Fed minutes, but Fed funds. But
yes.
ZN. This is sideways price action. We're not expecting the bottom to happen yet. This could very well go sideways for the next 6 months, maybe even a year, depending how long this stagflationary regime lasts. But we don't see deflation coming yet. And deflation is what you need for ZN to go up, hit Momo, go blow through Momo. You know, the real conviction trade. We don't have that environment right now.
Right. And just to make you aware, the past two rallies here that I just checked, they're you're looking at almost a 3% counter trend move. Right now, we're a little bit above that now, given the moves wider off the bottom, but uh, these types of runs are not abnormal. Even ZN running all the way up to 124s, 123s, even 127. Not it, will it look bad on TLT? Will you be like, oh wow, I'm missing the move? It'll feel that way. But just remember where rates are right now. The 10 years trading just under 3% as of today, right? Or 300 basis points. So we're at 300 basis points. If you think that we're going to have a really bad recession and we're going to go back under, 2-3%, or I should say under between 2 and 1% in that ballpark, this move from here to here, there's plenty of room higher than just this little move. So from ZN going from 118 to 127, there's much more room there in a real recession.
Yeah.
So you don't have to be scared of missing the move. And I think the most important thing is you shouldn't use emotions when it comes to this, because no matter where this goes, it's all about allocation of capital with proper leverage risk management, right? You don't want to be in something, because we're not going to play bonds with TLT. We're not going to do that. Why? Well, because the return on capital is not what we'd like it to be. There's people that follow us that TLT will bode very well for. They will make a lot of money with TLT, and they can manage risk a lot better with TLT because the leverage is not there. But for us, when we have the regimes in our sales, we're looking to take high conviction trades. And those high conviction trades means that all of our I should say all of our bullets, or all the wind is backing our sales. So we have this big conviction that we can basically put into a position, and we are okay putting sides behind it, because remember, we have the conviction of all the things lining up in the way that we want them. So we don't mind using leverage with high conviction. Without high conviction, if you're buying TLT for the yield, if you're, let's say, looking at TLT's yield right now and you're saying, well, I really like this yield, I find this attractive over the next 20 years for myself, that's a different story. That's not what we're doing here. We don't really care about the yield on any of these things, because first off, the leverage products don't have anywhere near the same yield, and we're looking to make those gains and sell them. This is not a 60-40 book. This is not a strategy where we're trying to collect as much dividends as possible. This is appreciation, gains, liquidate, and do it again. Appreciate, liquidate, and do it again. This is not like a strategy to reinvest dividends over the long run. So that's the most important part. This can get caught sideways. It's done it time and time again. When there's a big liquidation, it's not abnormal for bonds to chop sideways. Why? Well, there's not a pivot in. What ends up happening is bonds are moving faster than the regimes can pivot, and there's no conviction yet for that deflationary pivot. Now, if it happens to come, we will see bonds. It's extremely likely we'll see bonds in bullish trend by that time. So until bonds turn around completely, we don't. The last thing we want to do or invest into, or basically allocate capital into, is a counter trend rally, because those, as you can see, those can get liquidated very harshly. And let's while we're talking about interest rates, I think it's time that we pivot into the federal funds rates, and what we're seeing is the market's pricing in. So on our website, we added this section under market analytics called the Fed Forecaster. By the time you guys see this video, there will probably be some more, I should say, aesthetics added to this to make it look a little better, explain some things. This is like a rough outline. For those that are website members, you guys have access to this already. I think I told you, I alerted the chat room today that you guys can go and check this out. But for the video, we're going to go over the basics here. So let's take a look at the number of FOMC hikes/cuts in the next 3 meetings. So what this is telling you is that as on Bloomberg, the next meeting has 100% chance, 100% chance of 2 rate hikes and a 59.7% chance of a 3rd rate hike. So we're still well in the three rate hike area.
Well, so
And
odds of 3 rate hikes have lowered
they did.
significantly, right?
They did.
It
But we're
used to be
still
almost
there.
guaranteed.
Yeah, it was almost 3 it was almost 3 it was like 2.9 or
Yeah,
2.8
so
something.
it's come
Yeah.
down quite a bit.
We're still looking at a 3 rate hike though. Again, it's still 60% chance. It's over majority right now. So, is it as likely as it was before? No, it's not. And a lot of things have actually changed across the curve. And we're going to go over that. So let's take a look at the next meeting in September. We're looking at another 100% chance of 2 rate hikes, and then a 49.5% chance of the third rate hike. So of an additional rate hike. So in the next 2 meetings, we're looking at pretty much 4 guaranteed rate hikes. Right?
Yeah.
So we have two here and 2 here. That's 4 guaranteed rate hikes in the next 2 meetings. Now, what does this mean for the federal funds rate itself? This is our second tool we put on here. It's the forward curve, and it uses the data from this and extrapolates it to the federal funds rate as of where it's today and where it should stand by the end of the curve, or by the points in time of the curve where these rate hikes or cuts would occur. So we're at 158 basis points right now on an effective federal funds rate. But this next meeting in July should get us up to 223 basis points. We're seeing the curve peak around 351 basis points early 2023. This was actually higher. This was all the way up towards 400 basis points back in late May, early June. So this has slowly been fading. What's that telling you? What does that mean if you see this fading? Well, it's telling you that the Federal Reserve is not going to have to do as much. Now, this
That's
is
what
not an
bonds
opinion.
are pricing in
Right.
right now, right?
Well, that's what the Fed funds futures are pricing in, and the bonds and next to the Fed funds futures, the bonds are pricing this in as well, which is why you're seeing why you're not seeing that excessive ramp in yields anymore. It's almost like it's chopping sideways and lower. And break evens are also breaking down, but we'll get into that later in the video or in the podcast. So, what this is telling you is that the Federal Reserve should be peaking around 350 basis points as an effective federal funds rate, meaning after March of 2023, we're going to start seeing rate cuts. As you can see here in March 2023, right? We start going in the red. Now, this is 3.3% chance of a rate cut. This is almost negligible. And then here we're at 47% chance of a rate cut in June of 2023. So it's basically telling you the curve's going to peak at 351 basis points as of today. Remember, a month ago, you were closer to 4.
Mm-hmm.
This will change. This will progress. And this is how we watch and see what the market's thinking the Fed's going to do. Bonds are looking at this. Everyone's looking at this, right? The markets are pricing the data off of this is pricing the data off of where the market thinks the Federal Reserve is going to go. So it's important that we watch this because the market itself will price certain things will price what they're going to do off of what they think the Fed's going to do. So this is why this is an important chart. Mm-hmm. Now, before we continue into the next segment here, I think it's really important that we talk about one of the biggest issues that we can run into. And I think that's where we see some further abatement in inflation expectations. And the Federal Reserve does a grave mistake where they decide that they can take their foot off the gas. And
they see inflation slowing, take their foot off the gas, and then inflation ramps back up and they're behind the curve.
Right. So just remember this. The Fed is only seen to be in front of the curve or at the curve post December of 2022. They still have to hike rampantly. Remember, in the next 3 meetings, we're getting 5 rate hikes. So the Fed's obviously still behind the curve, right?
Yeah.
So they have to get to the curve. The problem is if they think that they can take their foot off the gas, which again, Powell's been saying pretty consistently that he's going to do everything to tame inflation pretty much. So I don't think they're going to do this, but it wouldn't be out of the question given the Federal Reserve is they always do things. They do the worst things at the most inopportune times. It doesn't really make sense what they're doing.
They're just notorious for fucking everything up.
Yeah. So I think that if the if you see an abatement in inflation, there's a possibility, and I'm not saying they're going to, that they're gonna start playing games with the rate hikes being priced in. Now, if it's if it's something that's like dramatic, where we have inflation falling completely off a cliff, sub threes, which again, we're talking way left field, improbable, statistically improbable. But if those things were to happen, the Federal Reserve will have to change their path. What I'm saying is the Federal Reserve changes their path before we get to December, so they don't get the 351 basis points. Right now, we're killing inflation expectations with this curve. Does something happen where inflation expectations pick up? Possible. If that's the case, they will need to do more, and this will shift back towards 4. But right now, we're sitting at 3.5. Does the Fed get here? Could the economy go to shit prior? Possible. But it's important that you understand the market's pricing in this rate right now, the peak of 350 basis points, right? It's important that the listeners here understand that what they're seeing happen in crude, what they're seeing happen in all these inflation expectations. And I think a great analogy, a great way to explain this is we had some PCE numbers come out today that were much lower than expected, right? Or lower than expected, I should say. And it's giving people the idea that, oh, inflation's peaked. So the market's going to rally now. And I think it's very important we use this analogy. For those that watch this, that know anything about sports betting, there's what we call a money line, right? The money line is when you take the win or lose of each team, right? So, or the win of each team, the bet that one team A or team B is going to win. That's what we call the money line, right? That's sports betting. So that money line will change throughout the game. So let's take a game of baseball, for example. Keep this short and simple. There's 9 innings. That money line, those odds at the beginning of the game before the game starts are going to fluctuate from, in the 5th inning and the 8th inning and so on and so forth. They're not going to be the same odds throughout the whole game because the game's going to progress. You're going to have people score runs. The score is going to change. The team on top is going to change. Those odds will shift too. So the reason I use this analogy is think of economic data. The economic data that is released today was at least 1 to maybe even 3 innings ago. Okay? So, and think of the market as the money line odds, the market price, or the pricing of everything in the market. So, say we are in the 5th inning and data from the 4th inning comes out, right? Is it going to change the money line odds drastically? Because those money line odds are changing throughout every inning. They're progressing. The odds of the game progress as the game is played, not sitting there waiting for what happened last inning to come in and push the odds forward. Now, can the market move on certain economic releases? Of course, but it's mainly pricing those in as time goes along because the market is the ultimate forecasting tool. A lot of people make nowcast models, this cast, whatever cast, right? You can go to the beach and cast a fishing pole for all I care. Doesn't really mean shit. Okay? Because at the end of the day, the market is telling you today what's going on, right? So those PCE number, or call it CPI numbers, the market's pricing in inflation today. What you're paying, what you're betting on, like in baseball, you're betting on what's happening right now, not what happened in the past. Or any sport, not just baseball. But those odds updating real time, just like they are in any betting game or whatnot, or even options markets, they're live. They're calculating everything of what's happening right now. So you can't look at the market and say, okay, SPY's at, call it 374 or whatever, 370, right? Inflation numbers are going to come out. We're going to rally 15%. No, that's not what would happen. The reason the market would rally 15%, right, is if inflation got decimated to the point where the Federal Reserve didn't have to hike, but growth rebounded. All those have to change real time for the market to recover. Because then you would get what we call expansion, where inflation is decelerating, but growth is accelerating. If you have inflation numbers come in hotter than expected, it's obviously not good for the market. Why, though? Not because Let's say next month in July, July's numbers are, excuse me, in July, June's numbers are higher than May's numbers, which, given the move in crude, is unlikely. But just hear me out, right? Let's just say that happens. Is the market surprised that inflation is higher than expected? No, it's not. What the market's surprised about is how this graph here changes, because
Hmm.
this is telling you where the market's forward looking, right? That the market's looking out, the market's not looking behind. All those data sets that everyone talks about, released on CNBC, whatever, those Bloomberg headlines, those are reference points to build an educated guess. But in reality, the market's already priced those things in. You
Well,
know,
that's why it's so hard to forecast the market, because you're essentially trying to forecast a forecaster.
right, exactly. So the market. So think about it like this: the market's already a forecast, and you're building a forecast model off something that's already being like it's already forecasted for you. It's kind of like, again, we'll go back to the betting analogy. If you have an underdog and a team and a favorite, right? The reasons these betting companies or these sports books make so much money is because their forecasts are accurate enough to the point where they can give you better odds to bet on an underdog, and the odds are that you won't win, right? Because if there was an inefficiency in the sports book, there would be no sports betting companies. So the sports betting companies have to be very good at predicting winners or losers, because obviously there's a vig and there's a spread, right? For those sports bettors that are listening. But regardless, the sports bettors you can't have underdogs that are always winning. You can't do that. You have to price the model accordingly. So what I'm trying to tell you is, just like a sports book, the market's the same thing. You think if the market had all these inefficiencies and we were looking at data that was 1 month back, there would be a huge problem in the market, because anyone that had access to that data would instantly be extremely rich,
Yeah. Well,
right? Because
so let's go on to the next
yeah,
topic. Let's go on
yeah,
to the next topic. So, what everyone is seeing now, they're seeing crude pull back. They're seeing ZN going up. They're seeing DBC, so other commodities, pulling back. These are all very deflationary signs.
right. And I think it's important that we go over what that means for our model and for us, right? So what does this mean, and why are we not getting deflation yet? Well,
Yeah, exactly.
the first thing is, if you we're gonna break this chart into little segments. We don't have too many of these, so this will be nice and sweet and quick here. So what we're gonna start with is, we're gonna start with the 5-year break-even inflation rate. It's currently at 258 basis points, but this is as of the 30th. Yes, as of the 30th. So this is as of today, it's 258 basis points. What this is telling you is, over 5 years, what is the break even? What's the expected rate of inflation on a yearly basis? So if you buy a note today, what is that going to yield you, or what are you going to have to take away from that note on a yearly basis to cost for inflation? Right now, it's 258 basis points. So it's expecting, on an annualized basis, inflation to be 250 basis points. Let's add the 10-year break-even inflation rate. That is 233 basis points. So what this is telling you is that there's more inflation in the next 5 years than there will be in the next 10 years. Makes sense, right? Because, and let's go back to COVID. There was more inflation over the next 10 years than there was in the next 5 years being priced in. Would make
Interesting.
sense, right?
Yep.
So this is simple. This isn't like a very complicated graph. The most important part is, we overlay inflation, the inflation rate. Now, we have break evens falling off a cliff pretty much since March, right? And this is why you have to be very cautious when using break evens for inflation, because even though break evens were going down pretty much, I'd say, in a downwards trend now, right? Inflation was able to print a new basically a new high, while break evens were pretty much on their lows.
So what does that mean?
So this is fueling to real yields, right? Because the Federal Reserve is still going to put the federal funds rate, as of right now, pricing in 351 basis points. So the nominals have to be up there. You understand what I'm saying? So the nominals, call it on a 10-year or even a 2-year, is going to have to be elevated, right? Or let's say a 5-year. If we put US 5, sorry, just here, right? A 5-year is trading at 304 basis points right now. Because remember, the Federal Reserve is expected to get all the way up to 351 basis points by March.
In light of everything we're seeing now, so crude oil, commodities
Right.
coming down, ZN going up, like all very deflationary signs. So a lot of people are pivoting and calling for
Right,
deflation
right.
now and longing bonds.
But what I'm trying to say is what they're not realizing is that you need to have a real powerful deflationary event. You need the Fed in your sales. You need them to be cutting.
Okay.
Because
So
if the Fed's not cutting, is there really a problem?
well, isn't the market pricing in that the Fed is going to have to cut because
Yeah.
inflation cools?
Yes, and I think that this is a better explanation for the 5-year yield. The 5-year yield is not. I I had bubbles in my brain earlier. The 5-year yield is pricing in 304 basis points in the term of 5 years from now, right? So remember, let's go back to the market analysis page. We're at 158 basis points. We're going to get up to 351 by year's end, 350, but we're going to come back down. So it's think of this graph extrapolated over 5 years is what the 5-year yield. Obviously, there's a premium over Fed's funds rate for treasuries, right? But what this is telling you is that what I'm trying to explain to you is that these break evens declining, they can't decline as fast as the nominals can, because this goes back to the whole point of the Fed having to do their cycle. If the cycle is going to change a lot slower than the break evens. The break evens are falling, which means the real yields are widening. Does that make sense? Which means economic conditions will continue to get tighter.
I see. Okay.
Right. That's what I'm trying to get at. The nominals will stay up here for a while because the nominals have to price in this whole thing.
Yeah. Okay.
And the break evens are pricing in this whole thing as well, but the nominals are almost anchored because it's priced in the Federal Reserve is going to here. Does that make sense?
Yeah, that makes sense.
Yeah. Okay. So now what does this mean? Let's get into your question about crude. So let's overlay crude onto this chart, and we'll take off the 5-year and overlay crude. As you can see, crude's holding up actually rather well. If you look back, crude and what is this? The 5-year inflation expectations, they tend to move together. Let's disable the 10s, and let's disable the inflation rate. So see, they tend to move rather in synchronous. So what's going on? Why is the break even falling, but crude is not yet?
Yeah,
Something's
what's
going
up with
on.
that?
Right.
Why is that happening?
Why is that happening? It's real simple. The market itself is pricing in a slow in inflation, but the slow of inflation is not dramatic enough to shock the demand that there is in commodities because of this whole shutdown. We had this whole move here, so we basically screwed up all the supply. Now we have demand coming back, but we've lost all this supply / production / creation of all these goods and materials. That even demand coming back, you would need a substantial crush in inflation itself to destroy this, because the market's so tight right now that you actually can have less demand than usual to support this market. Does that make sense?
Mm-hmm. Yeah.
So like, look over here. If we go back in time, crude falls, inflation expectations fall. Rather same when they bounce, they move almost the same, right? Well, you just didn't have a catastrophic demand, or I should say supply destruction and demand destruction. You killed demand by shutting the economy down. Then you killed supply on the way back up by putting all the manufacturers behind the curve.
Yeah.
You didn't have that here. So what you end up having is you have artificial demand it's almost like giving demand a curve. Like, imagine if I gave you a test and I curved the grade, call it by 20%, whatever that number is, or that arbitrage number. that is demand. Basically, you have to take demand and slide it over, give it 20 more percentage points of power or whatever. 20% is not the real number. This is just an analogy, right? You're basically giving it a curve because you are having an issue with supply. We can't produce enough. We can't even get more barrels of oil. We're having a problem basically pushing out barrels of oil and then on top of that refining it. So there's this just pent up demand right now. Will it break eventually? Yes. But you have to look in the scope of the regime, right? What's going on? And this goes back to the baseball analogy. Remember, the market is pricing this in real time. This is not, oh, we're waiting for June's numbers in July and we'll see what's going to happen. Maybe the Fed is doing that, but the market is not. The market's creating a variable for inflation and giving it that variable. And the market's rather accurate in what it does. Is it the best? No, but it's right more than it is wrong. Because if it was wrong, there'd be too many rich people. If it was wrong all the time, people would be just rich.
It would be too easy.
It would be too easy, right? The market is like I said, like a sports book, right? The favorite on winning is always going to have worse odds. Mm-hmm. Why? Because the house is not trying to lose money. Market makers aren't trying to get gaped. Okay, they're gonna set the price, right? Or the market makers and participants are going to set a price that is what is deemed acceptable today. Now, there's fluctuation. Yes, there's deviation from means. Smaller cap stocks can move at higher, up 100% in a day. Obviously, that's extreme. But you get my point. Over the long term, over this year so far, this move is not irrational. That's my point. This is not like, oh, inflation's top peaked, we're going to just turn around and go in a straight line. You would need a lot of things to happen with inflation peaking for things. Now, will those things happen if inflation were to peak? Yes, but inflation is not going to just peak on and roll on a dime. This is a multi-month, multi-quarter progression. We saw that. We'll look at the rally. This whole inflation move, the market ran for almost over a year and a half. And now we're pulling back because the problems that the Fed faces with inflation, once those get resolved, and then you see a pickup in growth. You can't just have inflation peak, because guess what happens when inflation peaks? Do you think the market rebounds? We get what we call deflation.
Yeah, then the real shitter happens.
Yeah, now can the market rally in deflation? Yes, it can. We saw that happen here. Where we got deflation, the market went up. Ultimately, though, it didn't really, we had mega drawdowns in between, didn't really go anywhere, where bonds were the preferred investment. Again, if we see deflation, we're not going to be crying about a potential equity rally, because if we see deflation, odds are bonds will be outperforming equities. So why worry about what equities are doing? You're making more money in bonds, which on top of that, if you lay the leverage down, you're going to be doing even better.
With smaller drawdowns too.
With smaller drawdowns, which is why we say be patient. Let the regimes hit your sales and go fast with confidence. If not, it's like running into a dark room, with a bunch of knives sticking out of the walls. Eventually, you're going to get stabbed. It's going to happen. You're going to just run around and eventually you're going to hit a knife and you're going to be dead. Yeah. That's what's going to happen, right? So
that's not a good long-term plan.
No, that's not a good long-term plan unless you just plan on sitting in one place forever and not moving. Yeah. Which, some people like those 2% dividend yields. I mean, if you had 100 million, 2%, yeah, I understand why you want to just make dividend income. It makes sense. Unfortunately, either of us don't have 100 million yet, but one day we'll be in that chair.
Just give us a few more risk on regimes and we'll get there.
Yeah, give us a few more risk on regimes is right. But let's move on here and let's talk about inflation or break-evens, 5-year break-evens. So remember what we spoke about here, the blue line? Well, we're going to have that over here too. That is now the white line. And we have DBC as the candlestick, and DBC is the CRB index ETF. So it's very important. You look at DBC, and if we take a measured move off the highs, DBC is down about almost 14% off the highs, 13.5%, 14%, whatever. We're not at Momo yet. So the trend is not bearish yet. To look at break-evens. Break-evens are off of 360 5-year break-evens were 360 basis points back in March. Now we're at 258 basis points. So 360 basis points to 258 basis points.
And so what is that telling us?
That's telling us that inflation expectations are dropping, right? But just remember that everything is priced now. Everything's priced today, right? So you're looking at DBC like, oh, look, inflation expectations are completely destroyed. DBC can go much lower. What this is telling you is that with inflation expectations going down, DBC hasn't even broken Momo yet. Hasn't even put a bearish trend in yet.
Okay.
You don't think commodities priced this in already? Of course they did. Right? There's no real leading indicator that or by multiple months that you're like almost going to guarantee something. But I mean, obviously we have the system, right? The system tells us what is today, and obviously regimes are multi-month, multi-quarter lasting. So once we can figure out what's going on today, it's likely going to stick around. This is not telling you what's going to happen for the next 3 months, 6 months, a year, because it's very hard. And I've done my fair share of work in trying to do it. It's very hard in building a forecasting model for a component that's already forecasting. The market's already forecasting. So you're basically building a forecasting model off of a forecasted component. Does that make sense?
Yeah, and it just doesn't work.
It doesn't work
I mean,
because
if someone figures it out, let us know.
Yeah.
But I feel like it's been tried and tested for hundreds of years and no one could figure it out.
It's literally what Wall Street's been doing with these inflation expectations, right? Like their forecasted inflation numbers. Now, are they close? Yes. Are they accurate? Are they close to? Yes. Does it really work? Let me explain something to you. I think it's very important that anyone listening to this that's paying astronomical fees for services understands something. If the service worked, or I should say, if the model worked to the degree of being able to front run market inflation or market and moves in inflation and growth on a forecasting model, and it works so well, they wouldn't need your money. Yeah. They wouldn't even want to tell you that they have it.
Exactly.
That right there is a tool. Okay? That is a tool. A multi-billion-dollar tool. Why are they going to give it away? For $40 a month? $30 a month? Like, you're telling me I can pay twice as much as I do for Netflix and I can make billions of dollars? Obviously not. If that was the case, these people would be running real money and making their own money, or they wouldn't even need to run real money, because the compounding effect of something that powerful, you wouldn't need to run someone else's money. You could do it yourself. This goes back to the whole worry about what's happening now and look into the future and make assumptions. Okay, we're in stagflation. We've been in stagflation. Likely, based on history, next is deflation. When deflation comes, we'll be in deflation for a while, so we'll long bonds. The key difference is I'm not sitting here telling you when we're going to get something. And that's what I mean by this whole like billion-dollar tool. There's a lot of tools out there that can read what's going on right now. There's a lot of tools out there that can do short-term forecasts. Those are fine. Forecasting 1 month is not really that useful. Forecasting 2 quarters, if you have an actual tool that can forecast more than a quarter out, I mean, you're
making bank.
You're making bank. Right, but the whole thing is remember, the market is always right. Don't fight the market. Don't fight the Fed. The Fed can strangle the market to an extent. The Fed is the market's only only enemy, or basically opponent that can play on the same playing field. So don't fight the Fed and don't fight the market, because they can battle each other. One will win here and the other one will win there, whatever. But like, you are like
you're gonna get destroyed every time.
You're gonna get destroyed in the crossfires.
Yeah.
And I think this is where we're gonna segue to the final part, which is VIX. And I have DDAP enabled with a line chart. And in risk-off regimes, it's very common statistically we see wider and higher VIX. And all year long, we've been seeing that. Look at last year, kind of compression, right? Now we're getting these megaphone moves and we're grinding higher. It's very likely that the VIX high is not in yet. Unless we get a 2018 event where we get deflation and equities kind of rebound or sort of rebound while bonds outperform, which is always a possibility. But for that to happen, you would need a drastic shift in events. Right now, we're not seeing those. But if that did happen, VIX could potentially go lower, given this is what 2018 looked like. We had the end of 2018, and VIX was pretty much at 30s to 34s, and we dropped the whole year, basically wedging these rallies that were into a wedge, and we broke out. We still wedged, and then we had the COVID event, which was all part of one regime, deflation. So in the grand scheme of things, VIX went a lot higher than 30, 35 in deflation. But you understand my drift. You could have a counter trend move in equities, and while bonds outperform, VIX will peak. But that's not what we're seeing right now. What we're seeing is VIX did not peak yet. VIX is not going to peak at 36. I mean, let's put a candlesticks on to see really where we're at. Yeah, I mean, the high here in January was 39. VIX can see 40s plus no problem.
Yeah, the odds are definitely in that favor.
Yeah. Again, sports betting, it's the favorite, right? It's the negative money line right now that VIX goes higher. So it's in your favor that VIX goes higher. And I think we're gonna just speak about where the Federal Reserve has been and what it's meaning with crude before we finish up the podcast here. So what I have laid on this Bloomberg chart is the blue line being the price of crude and the white line being the expected federal funds rate in December of 2022. Now, if you remember, on our website, we have the expected values of each meeting or each month of the federal funds futures. But what you can't see is the depth of each meeting over time, which is what I'm showing you here. This is specifically the December meeting, but historically over the last basically couple of years here, you're seeing what has been priced in to the December meeting. Now, as back in January of this year, we were at basically 75 basis point federal funds rate. We're now at 340 basis points. So as you see, this is a January of 2022. I want to clarify. So in the last 6 months, we've pretty much gone parabolic. Crude's gone parabolic as well. And what you're seeing here is you're seeing the Federal Reserve having to hold. Does not look like the break-evens chart that I showed you guys earlier here, where break-evens are almost falling off a cliff, right? They're down pretty deeply. I mean, we're printing the new 2022 lows here. Meanwhile, the Fed rate hikes are not. They're holding up rather well. We're still above June 10th's number. Crude is holding on sideways. Well, that's because while break-evens are basically pulling back, the market's still pricing in the Federal Reserve needs to take these actions. If they don't take these actions, as I was saying earlier, the biggest mistake we could make is they don't take these actions and these start going higher and this has to move even higher. So it's a very tight situation where if anything happens and break-evens start ripping higher, this is going to have to go higher.
And so that'll essentially crush all deflationary players.
Right. And something you just have to have a supply issue coming up here in the next 2-3 months, and this can easily revert. Mm-hmm. This can easily go back up. Now, if this goes back up and makes new March highs, if this really starts ripping and starts chugging along even just half of this move, this is going to be higher again because it's going to show that what the Fed has done and priced in is not enough. Remember, if these start ripping higher, this is priced in. Well, this is not enough. Right now, this has been chilling a bit because it's seeming as if this is enough. Crude's off the highs. Break-evens are off the highs. This might be enough. All you have to happen is a snap of a finger, real time something change. And the future will have to be changed with it. So that's what matters. Not what June's inflation number is going to be? Will it be lower? There's a chance. Will it be drastically lower? Probably not. But what I'm trying to get to, the point I'm trying to get across to you and to those listening, I should say, is the market is pricing in everything on the screen that you see, the break evens, the VIX, the crude, the expected federal funds rate, all across the entire curve. That's all being priced in real time. If you don't think it's being priced in real time, and you think the market really cares about what the
Or
number's
if you
worth,
think it's wrong, if you think
or
like bonds are wrong,
yeah,
like there's a
let
lot of
me,
people that say that, bonds are wrong. They're not pricing it in yet. No,
yeah.
no. If you think bonds are wrong, you're wrong.
yeah, if you think any of this stuff here is wrong, while it may not be, it may not be in the right direction. But all this stuff here is right as of today. Does that make sense? You know what I'm saying?
Yeah, yeah. Like
This is not
this is as right as you can be today.
right. This is the ultimate forecasting tool. Given everything that's going on right now, if break even chug around 258 basis points to 28 to 260, they think that the market thinks that the federal funds rate will pretty much only get to 340 basis points by December. Now, obviously, if this grinds a lot lower, this will go lower. But they can't really break policy unless there's a drastic change here, because if you break policy too early and this goes the other way, it's like, you're going to get your neck broken. The Fed's going to have to start the whole market's going to have to start repricing more rate hikes. So it's very important that you watch all this stuff and say, well, if we want deflation, right? Just because break evens and crude is down, if you want deflation, you're going to need this to go bearish trend. Commodities are going to need to go bearish trend. You're not going to get deflation with commodities in a bullish trend. Now you're like, oh, commodities are not right. Well, let me tell you something. The commodities, if they were incorrectly priced, there would be too much. Again, look at lumber. Lumber's in the shitter. Why is lumber in the shitter? Because growth's in the shitter, right? Why is crude not in the shitter? Because we have a supply issue, right? And that supply issue is very important, because that supply issue is what is creating inflation. And then on top of that, we also have this excess money supply, which has to get eaten up back, by the Fed. It's not going to get eaten up at a rate that's acceptable. But as I showed you guys and I think it was 3 or 4 podcasts ago, the CPI index will go up over time. It rarely ever goes negative, right? So we're going to have we're going to have a consumer price index that's pretty much always rising, which you need to have. You need to have it in an inflationary money supply, because if it was deflationary, no one would spend any dollars. Long story short, to get the deflationary regime, you're going to need to see commodities become in excess to the point where the demand is destroyed. It's very hard to have demand destruction, or say there's demand destruction across the board in the inflationary component of the consumer price index, or I should say the rate of change of the consumer price index, when the commodities basket is not even bearish trend yet.
Yeah, there's not enough supply.
Right, there's not enough supply. There's just not, and this will go bearish trend at some point. But it's very important that let's look back at what happened with COVID. COVID was a drastic drop, but let's look back here, because even if we look back in time, in July of 2018, right? July of 2018, where were we? This is a little example. Let's look at July of 2018. We were in inflation, right? And we hit stagflation. We got it at 10.518, right? So 10.518 is right here. We got the stagflationary trigger, which was bearish. I got this backwards. I'm sorry. So we got the commodities go bearish trend in the inflationary regime, warning sign. They go bullish trend and immediately reverse and go where we get the stag.
Bottom line, it's like there's no point in front running it, because you get the meat of the move.
Yeah.
If you just wait it out and wait for the optimal time to enter. Like, you're not gonna be timing tops and bottoms, but who gives a shit? You're gonna be getting insane moves, especially if you're playing leveraged ETFs. It's low risk because all the wind is in your sails. You're not going to be getting large drawdowns. That's the way to do it. And that's what we're waiting for.
We get the deflation pivot here, And like you said, there's enough time to take advantage of this whole move here. Which again, it stayed deflation here. So you pretty much were this was the fake out. I have my time periods wrong. This is not the fake out. This was the fake out where we were in deflation and commodities go bullish trend. That's nonsense. The
Hmm.
regime is not support. If the regime does not support the trend, then the trend is wrong. The regime, the system is pricing what the market's telling you. This is only pricing what commodities are telling you. So you have to put one. You can't just use one thing. You have to put the two pieces together of the puzzle and get the big picture. This you could have been short commodities this whole drawdown and gotten out here. You would have shorted DBC up at 17, all the way down to COVID 10s, even 13s. Nice gain, right? There's no reason. There's nothing here. There's no regime supporting this going lower. This not bearish trend as a potential, as a signal the regime could be shifting, because that's all that this is. This would be a signal the regime is starting to shift, right? You're
Hmm.
getting the intra component of the components within the market are changing. It's a sign that things can possibly change. The regime stayed strong deflation, so this was ignored. We're not getting the opposite here. It's not like we're in bearish trend right now. We're in stagflation. We're going to have the chance of pivoting to deflation. We're not even in a bearish trend with commodities. So what are we worried about deflation for just yet? Doesn't
Yeah,
make sense.
it's
And I
just
think that's where
such a
we should
small
leave it off.
move. Yeah. Thanks for listening, everyone. If you have any questions, we've got our Discord. We'll be happy to help.